Welcome to the Pro Tigger Deep Dive.
Glad to be here.
It is Wednesday, February 25, 2026. And I have to ask, can you feel that?
Feel what? The temperature finally rising?
Well, yes, I mean, spring is technically right around the corner, but I'm talking about something else entirely. There is a very palpable shift in the air right now. A thaw, if you will.
Ah, I see where you're going.
Yeah, not the weather. I'm talking about a massive, multi-trillion-dollar financial sector that has been effectively encased in carbonite for the last 3 years.
You are talking about the housing market.
I'm absolutely talking about the housing market because for years now, we have been staring at this massive, incredibly intense Mexican standoff.
Right.
Buyers couldn't buy because the monthly payments were astronomical. And sellers, well, they wouldn't sell because they were completely addicted to their 3% rates.
Yeah, everyone was just paralyzed.
Exactly.
Yeah.
But here we are, late February 2026, and looking at the data we have on the desk today, the standoff is breaking. It really feels like the hibernation is finally ending.
It really does. I mean, we're seeing a convergence of factors right now that we really haven't seen since the start of the decade.
Okay, unpack that a bit.
Well, you have mortgage rates finally respecting a magic number. You have a slew of incredibly aggressive government interventions flying out of the White House.
Right, which we will get into.
Yeah, and some of which are controversial, to say the least, but they are undeniably impactful. And perhaps most importantly, that infamous lock-in effect where people just flat out refuse to sell their homes is finally showing some serious cracks.
So the mission for this deep dive is pretty clear for you listening. We need to decode what this new normal of 2026 actually looks like.
Exactly.
We aren't just reading the headlines here. We need to unpack the mechanics of these new policies, everything from the 50-year mortgage proposal to the ban on institutional investors.
You have to look at the math, not just the sentiment.
Right. And ultimately, we need to answer the burning question for everyone listening to this. Is the waiting game finally over?
It's the multi-million-dollar question, or, given where home prices are these days, maybe just the multi-$100,000 question.
Fair point. Okay, let's unpack this. Let's start with the number everyone obsesses over, the mortgage rate.
The big one.
Where do we stand right now? Today, February 25th.
So as of this morning, the national average for a 30-year fixed-rate mortgage is hovering right in that 6.04% to 6.09% range.
Wow.
And if you are aggressive and looking at a 15-year fixed, you're looking at approximately 5.45%.
Okay, 6.04%. I think, to be honest with you, and I think I speak for a lot of people listening, when I hear 6%, I don't immediately think, oh, bargain of the century.
Right, it's not a fire sale.
It certainly doesn't sound like the 3% glory days of 2021, so why should we be excited about this?
Because context is everything here. Sure, it's not 3%, but 6.04% is the lowest level we have seen since September 2022.
Wow, okay.
That is a very long time in financial years. It represents a psychological floor that we have been trying to break through for ages.
Right.
It's the difference between a monthly payment that is mathematically impossible and one that is merely uncomfortable.
But are we looking at this through rose-colored glasses? Like, if we zoom out, where does 6% sit historically?
This is the critical insight for you listening. If you look at the historical average from 1971 to 2025, the average 30-year rate is roughly 7.74%.
Wait, almost 8%?
Exactly. So historically speaking, we are actually below the 50-year trend line. We aren't in the unicorn years of 2020 and 2021 anymore.
Because those were an anomaly.
Right, caused by a massive global crisis. But we are also nowhere near the crisis levels of the early 80s, or even the average of the 90s.
So our baseline was completely skewed. We essentially got addicted to free money.
Precisely. We anchored our expectations to an emergency interest rate policy. Now that the emergency is over, 6% feels high. But in a functioning economy, it's actually quite standard.
That is a really tough pill to swallow for people who vividly remember 2.9%. But I get it. We have to adjust our baseline.
We do.
But it hasn't been a straight line down to 6%, right? It's been a bit of a roller coaster just in the last 2 months alone.
Absolutely. Choppy is a very polite way to put it. Volatility has been high.
How high?
Well, in early January specifically, around January 9th, we saw rates briefly pierce that 6% floor, hitting 6.01% or even slightly lower on some indexes.
That was a huge moment for the bond market.
It was. It tested that psychological barrier, but they bounced back. The market is finding a lot of resistance at that level right now.
I want to pause on that resistance concept because it's important for the listener. Why is 6% such a sticky number? Is it just completely arbitrary?
No, it's not arbitrary at all. It's about the spread.
Okay, explain that.
Mortgage rates usually trade at a premium over the 10-year Treasury yield. Historically, that spread is about 1.7%.
Okay.
Right now, the spread is still elevated because investors are worried about volatility. They demand a higher premium to hold mortgage debt.
So even if Treasury yields drop,
Mortgage rates are lagging a bit, yes. That 6% is where the risk and reward balances out for investors right now. It is very hard to break decisively below 6 without a recession or a drastic shift in the broader economy.
because the bond market looks at the economic data, which is still relatively resilient, and basically says, we can't go lower just yet.
Exactly. They need a reason to go lower, and a strong economy isn't a reason.
Okay, so 6% is the floor for now. Now, I want to challenge the narrative that everyone is rushing to refinance. Because if I'm sitting on a 3% mortgage from 2021, 6% is meaningless to me,
You wouldn't even look at it.
right? I'm never touching that loan. So who exactly is driving this refinance renaissance we keep hearing about?
It is a refinance renaissance, but it's a very exclusive club. We call them the class of 2023.
The people who bought at the absolute peak of the rate hike cycle.
Exactly. If you were forced to buy a house in late 2023 or early 2024, maybe you relocated for work, maybe you got divorced, you had a kid.
Life events.
Right. You might be sitting on a mortgage rate of 7.5%, maybe even pushing 8%. For that specific cohort, 6% is an absolute godsend.
Let's do the napkin math on that.
Yeah,
Is it actually worth the closing costs to do a refi?
it is. We estimate there are about 5 to 5.5 million borrowers who are currently in the money to refinance right now.
In the money, meaning it makes financial sense.
Yes. The rule of thumb is you want a rate drop of about 75 to 100 basis points, that's 0.75 to 1 full percentage point, to break even on closing costs within a reasonable time, say 18 to 24 months.
So if I'm at 7.5% and I can get 6.04% today.
You are dropping almost 150 basis points.
Wow.
On a typical loan size today, that translates to monthly savings of anywhere from $250 to $400.
That is real money for a household.
It's huge. That's groceries, that's a car payment, that's utilities.
And that explains why we're seeing reports of refinance activity jumping something like 88% year over year.
Correct. But here is the massive paradox in the market right now.
Lay it on us.
While that activity is exploding, it's coming from a very small slice of the pie. The vast majority of all mortgage holders, over 80%, still have rates below 6% because they bought or refinanced during the pandemic.
Right. For the class of 2021 holding a 2.65% rate, refinancing right now is mathematically impossible. You would never do it under any circumstance.
Precisely. So we have this highly divided market, the locked-in majority, and the recently purchased minority who are scrambling to fix their payments.
And that division, the haves with low rates and the have-nots with high rates, is exactly what the administration is trying to tackle. Which brings us to the Trump effect.
Yes, the policy side of things.
Let's get into this. Because the 2026 housing market isn't just about the Federal Reserve anymore. We are seeing aggressive, direct executive moves from the Trump administration to force affordability.
They're definitely taking a hands-on approach.
And just to be completely clear, for you listening, we are just looking at the math and the policies here. We aren't taking any political sides, just impartially unpacking what these executive actions actually mean for your wallet.
Absolutely. It's a major shift from monetary policy, which is the Fed raising and lowering rates, to fiscal and executive policy. They're trying to manually manipulate the demand and supply sides of the equation.
Right. So one of the biggest headlines was this $200 billion purchase order. Can you break that down? What actually happened there?
So back in January, the president ordered Fannie Mae and Freddie Mac, the government-sponsored enterprises that back most of our mortgages, to buy $200 billion in mortgage-backed securities, or MBS.
This is basically like the government stepping in as a whale buyer in the market.
Exactly. The logic is simple supply and demand. If you have a massive buyer stepping in to buy mortgage bonds, the price of those bonds goes up, and the yield, which corresponds directly to the mortgage rate, comes down.
Okay, that makes sense.
The goal was to artificially compress the spread between the 10-year Treasury yield and mortgage rates that we talked about earlier.
Did it work?
Briefly, that dip we saw on January 9th.
The one that hit 6.01%.
Right. That was largely the market reacting to this news. Rates dropped, but, and this is the key takeaway, they stabilized and came back up a bit.
Why didn't it stick? Because $200 billion sounds like a massive amount of money to throw at a problem.
It sounds huge to us as individuals, but in the context of the global mortgage market, it's a drop in the bucket.
Really?
Yeah. Consider this. The Federal Reserve holds roughly $2 trillion in mortgage-backed securities.
Oh, wow. Okay.
So $200 billion is a significant short-term liquidity injection, but it's not a permanent structural fix. It's like using a bucket of water to raise the level of a swimming pool.
You'll see a ripple.
Exactly. You see a ripple, maybe a temporary rise where you poured it, but it eventually levels out across the whole pool.
All right, so it's a nudge, not a shove. What about this other policy that's getting a lot of attention, the ban on institutional investors?
This was the executive order from January 20th. The proposal is to restrict or outright ban large institutional investors, think hedge funds, private equity firms, from buying single-family homes.
The idea being, stop Wall Street from competing with Main Street.
That's the slogan. And it resonates very well because we've all heard the stories of regular families losing bidding wars to all-cash offers from giant corporations.
It's incredibly frustrating for a first-time buyer. But does the data back it up? Is Wall Street actually buying all the houses?
There is a lot of nuance here. Nationally, institutional investors own a relatively small percentage of single-family homes. We're talking low double digits.
So banning them might not move the needle on national home prices significantly.
Correct. However, they are not spread evenly across the country. They are heavily, heavily concentrated.
Where are they buying?
The Sun Belt, Atlanta, Charlotte, Phoenix. In some specific neighborhoods in those cities, institutional buying was massive. They were buying up huge blocks of starter homes.
So executive order here could cool prices in those specific hot markets.
Exactly. It might really help a first-time buyer in Atlanta compete, even if it doesn't change much for a buyer in, say, Wisconsin or Maine.
That makes a lot of sense. It's a targeting tooling effect rather than a national freeze. Now, here's the policy that really caught my eye and I think sounds the most radical to the average listener: the 50-year mortgage.
This is a fascinating proposal. The administration is pushing for a standard 50-year loan term to become widely available.
Half a century. I mean, I'll be in the ground before I pay off the last payment if I took one out today.
That is the stark reality of it for a lot of buyers. But the goal here is purely cash flow.
Walk us through the math.
If you stretch the principal payments over 50 years instead of the traditional 30, your monthly payment drops. On a median-priced home right now, it lowers the payment by roughly $150 to $250 a month.
Which, as we know, could be the difference between qualifying for a loan and not qualifying at all.
Correct. It solves an access problem. It gets you in the door, and it is a massive, but it creates a severe wealth-building problem.
Because of the interest.
The total interest paid over 50 years is astronomical compared to a 30-year loan. And your equity buildup is agonizingly slow.
How slow?
For the first decade, you are basically paying rent to the bank. You own almost nothing of the actual home. Every payment is almost entirely interest.
So while it gets people into homes today, it might effectively delay the financial benefits of homeownership by an entire generation.
It's a massive trade-off. Immediate affordability versus long-term generational wealth.
And briefly, there's also talk about 401k access, right?
Yes, there are proposals to allow penalty-free withdrawals from retirement accounts for down payments.
Again, helping with the cash-to-close problem.
Right. But economists warn heavily about the demand-side risk here. If you give everyone more cash in their pockets to chase the exact same number of houses,
Prices just go up.
prices go up. You risk inflating the asset even further without actually building any new houses.
Okay, so that is the policy landscape. A mix of short-term fixes and some pretty major structural changes. Well, let's talk about the market itself on the ground. We mentioned the thaw earlier. Is the inventory actually coming back? Because for the last 2 years, there was literally nothing to buy.
The lock-in effect is finally eroding. And it's not just because rates dropped to near 6%. It's because life happens.
The 5Ds, right.
Exactly. Real estate is driven by the 5Ds. Diapers, diamonds, divorce, debt, and death.
You can only put off moving for so long.
Right. People have kids, they get married, they get new jobs across the country. After 3 years of putting their lives on hold, households are reaching a breaking point.
They just have to move.
And now that rates are 6% instead of 8%, the financial penalty of moving feels much less severe. It's still painful to trade a 3% rate for a 6% rate, but it's way less painful than trading 3 for 8.
So we are actually seeing more for sale signs in yards.
We are. Active listings are up roughly 10% year over year. And we are currently looking at the 27th consecutive month of inventory gains.
Wow, 27 months.
That is a solid trend, not a blip.
That sounds great for buyers listening, but are we back to normal? Are there enough houses?
Not quite yet. We are still roughly 12 to 17% below pre-pandemic inventory levels nationally.
Okay, so it's better, but we aren't exactly swimming in options.
Right. But there is a huge hero in this story, and it's new construction.
The builders.
The builders are absolutely saving the inventory numbers right now. We are projecting about 1.05 million new homes completed in 2026.
That's a lot of new inventory.
It is. And the builders are doing something very smart that existing regular homeowners simply can't do.
They are subsidizing the rates.
They are playing the finance game. Builders are using what we call rate buydowns.
How does that work for the buyer?
They take some of their profit margin on the house, and they use it to pay the lender up front to lower the interest rate for the buyer. So while the open market rate might be 6.04%, a builder might offer you a 4.99% rate for the first 2 or 3 years.
That is incredibly enticing. It creates a sort of shadow market.
Exactly. New homes are effectively cheaper to finance than existing, older homes. If you buy a used home, you pay 6%. If you buy a brand new home, you might pay 5%.
That is a massive competitive advantage for the builders.
It's why sales of newly built homes are holding up so incredibly well compared to existing home sales.
But this isn't happening everywhere uniformly, right? Because real estate is always local.
It is deeply regional right now. We are seeing a massive regional divergence.
Break that down.
Well, if you are in the Sun Belt, places like Texas, Florida, or the West, you are seeing huge inventory spikes. Those areas built incredibly aggressively over the last few years.
Lots of new homes.
Yes, and in some cases, they might even be slightly oversupplied right now, which is leading to some price softness and really aggressive builder incentives.
And what about the Northeast?
The Northeast and the Midwest are what we call the tight zones. They did not have that same massive building boom.
Right. Less available land, stricter zoning.
Exactly. So inventory is still incredibly low there, and prices are actually still grinding higher because there is just nothing to buy.
So if you're listening and you're in Austin, Texas, you might have some great options and leverage. But if you're in Boston, good luck.
That is the perfect summary of the map right now.
Let's talk about those prices overall. You mentioned softness in the Sun Belt, but nationally, are prices crashing? I feel like people have been waiting on the sidelines predicting a crash for 4 years.
And they have been wrong for 4 straight years. No, prices are not crashing nationally. The forecast for 2026 is moderate appreciation. We are looking at roughly 2.2% growth nationally.
2.2%. That sounds, well, boring, which is probably a good thing after the craziness of the last few years.
Boring is beautiful in the housing market. Stability is what we want. But here is where the math gets really interesting for you listening. We have to look at real prices versus nominal prices.
Okay, explain the difference.
Nominal price is simply the sticker price, the dollar amount on the listing. That is going up 2.2%.
Right.
But inflation, the cost of everything else in the entire economy, is currently running around 2.6 to 3%.
Okay, I see where you're going.
So if the price of a house goes up slower than the price of milk, gas, and labor, the real cost of that house, adjusted for inflation, is actually dropping slightly.
So the house is becoming cheaper relative to the overall value of the dollar.
Exactly. And even more importantly, it's becoming cheaper relative to wages.
Because wage growth is finally outpacing inflation.
Yes, finally. Wage growth is expected to be around 3.5% this year. So let's look at the numbers. Incomes are going up 3.5%. Home prices are only going up 2.2%.
That gap right there.
That gap is where affordability actively improves. It's not because home prices plummeted off a cliff in a dramatic crash. It's because incomes are finally catching up to the prices.
That is a much healthier way to restore affordability to the market than a crash.
It is. It's a slow heal rather than a traumatic, messy surgery. In fact, we're projecting that mortgage payments as a share of income will dip below 30% for the first time since 2022.
That is a huge key benchmark for household financial health. Now, what about the rent versus buy equation? Because for a while there, renting was vastly cheaper than trying to buy.
It still is strictly cheaper to rent in many markets on a monthly cash flow basis. Rents are softening right now. They are down slightly or flat in many metros because we have a huge glut of multifamily construction hitting the market.
All those apartment buildings that were started back in 2023 and 2024.
Right. They take a few years to build, and they were all finishing up and opening their doors right now.
So tenants have a lot of leverage to negotiate.
Tenants have great leverage. You're seeing 2 months free rent, rave deposits, but buyers still have that equity itch.
The desire to own.
Yes. Even if renting is cheaper monthly, the desire to lock in a fixed housing cost and actually build equity over time keeps buyers in the game. But the tension between renting and buying is very real right now.
Let's pivot to the puppet masters behind the curtain in all of this.
Yeah.
The Federal Reserve, we touched on this with rates earlier, but let's go deeper. Because the Fed actually cut rates in late 2025.
They did. They cut 3 times, totaling 75 basis points.
And yet mortgage rates went up or stayed flat in early 2026.
I think this specific dynamic confuses people more than anything else in real estate. People say the Fed cut rates, so why is my mortgage still 6%?
It is the classic, absolute, most common misunderstanding. The Fed controls the Fed funds rate, which is a very short-term overnight lending rate for banks.
Right.
Mortgage rates, however, track the 10-year Treasury yield, which is a long-term bond.
And the bond market has a mind of its own entirely. It absolutely does. The bond market looks at the future. When the Fed clearly signaled they were going to cut rates late last year, the market priced it in months in advance.
So mortgage rates drop before the cuts even officially happen.
Exactly. But then, in early 2026, the economic data started coming in hot.
The jobs reports.
Right. The labor market showed surprising resilience. Unemployment is sitting at 4.3 to 4.4%. That is still low historically.
Okay, so people have jobs.
And when the economy's strong, bond investors worry about inflation returning. They think if everyone has money to spend, prices will go up. So to protect their investments, they demand higher yields on those long-term bonds.
And when Treasury yields go up, mortgage rates get pulled right up with them.
Exactly.
So ironically, good news for the economy, people having jobs. Strong wages is actually bad news for mortgage rates.
That is the perverse logic of the bond market. We are in this Goldilocks scenario right now. The economy is not too hot to cause runaway inflation, but not too cold to trigger a recession.
And that prevents the Fed from slashing rates aggressively.
Right. If the economy was actively crashing, the Fed would drop the rates to 0, bond yields would plummet, and mortgages would follow right down. But because the economy is actually doing okay, rates stay anchored near 6%.
So we really shouldn't expect a return to 3% unless something absolutely terrible happens to the global economy.
Precisely. To get back to 3%, you need a major, painful recession. If you want to live in a healthy economy, you probably just have to live with 5.5 to 6.5% mortgage rates.
What is the outlook for the rest of 2026 then? Are we just staying in this current channel?
Consensus among economists is stability. We are likely looking at rates staying fairly tightly in that 5.9 to 6.3% channel for the year. But we do have a new Fed setup coming.
Right. Kevin Warsh has been appointed to replace Powell in May.
Yes.
Does that leadership change alter the math at all?
Markets expect him to be perhaps slightly more dovish, meaning more inclined to cut rates if given the chance, but he is ultimately just one vote on the committee. The broader economic reality dictates the path. Stability really is the watchword for 2026.
Okay, so let's wrap this up with a summary of where we stand for you listening. If you had to put a single headline on 2026 housing, what is it?
I'd call it the year of normalization.
Normalization, I like that.
We're finally moving away from the extremes. We aren't in the sheer panic of the pandemic buying frenzy where you had to bid 50 grand over asking sight unseen.
Thankfully.
And we aren't in the deep freeze of the 2023 rate shock where nobody moved at all. The market is balancing out. Inventory is slowly rising. Rates are stabilizing near 6%, and the overall panic is fading.
And refinancing is officially back on the table for those who got caught at the absolute peak.
Yes. If you are in that 7.5% bucket, check your numbers today. It is probably time to make a move.
So let's give the listeners some concrete, actionable takeaways. If I am a buyer right now, February 2026, what is my move?
For buyers, the frenzy is gone. You actually have time. You can sleep on a decision, do an inspection, breathe a little.
What a concept.
I know, right? Look for stale listings. Homes that have been sitting on the market for 45 or 60 days, those sellers are highly motivated to make a deal. And absolutely positively look at new construction.
Because of the buy-downs.
Ask every builder about rate buy-downs. That is where the actual financial deals are right now.
And what about for sellers?
For sellers, it is reality check time. The days of getting 20 offers in 24 hours are over. You have to price your home realistically from day one. If you price it right, it will sell because there is still solid demand. But if you price it like it's 2021, it will sit there for months.
Realism really seems to be the core theme here. You know, listening to all this data today, I have one final thought I want to throw at you.
Let's hear it.
We spend so much time in this country mourning the loss of 3% rates, We talk about it, we tweet about it, we treat it like we lost a birthright. But looking at your data, historically, 6% is normal. It's actually a sign of a healthy market.
It is.
So I have to ask you, and really ask everyone listening, is the biggest barrier to homeownership right now actually the price of the house or the mortgage rate? Or is it our own stubborn psychological anchor?
Oh, that's interesting.
Are we just entirely refusing to accept that the 2010s and early 2020s were the anomaly and not the rule?
That is the provocative thought of the day right there. We anchored ourselves so deeply to free money, and now that money actually has a cost again, we feel poor.
Exactly.
But perhaps the American dream isn't dead at all. It just got a necessary price adjustment. And maybe, just maybe, paying 6% interest is simply the cost of living in an economy that actually works, where people have solid jobs and wages are finally growing.
A price adjustment for a functioning reality.
Mm.
I really like that.
Yeah.
We will leave you with that thought to chew on today. Check your rate, check your local listings, and maybe, just maybe, it's finally time to get off the sidelines. Thanks for diving deep with us.
Always a pleasure to be here.
We'll catch you on the next one.